Doubling your money is a badge of honor that is frequently bragged about at parties and around the Thanksgiving dinner table. Overzealous consultants, or worse, scammers and fraudsters, can make false promises to double one's money. Perhaps the desire to double one's money stems from a deep component of our investor psychology, the risk-takers in us who crave a quick buck. So, what are the various investment options? What exactly are ETFs, and why are they touted as the most effective method? But first, hello and welcome back to the channel. This is Financial and Investment Wisdom, and we're back with another incredible video. Here we talk about the world of cryptocurrency, finance matters, and investments. So please subscribe to the channel and enable alerts to be notified of each new upload. When it comes to investment initiatives, two essential variables that are intertwined must be taken into account: time and risk. This applies to both your time horizon and your risk tolerance, as well as the characteristics of the investment itself, such as the time it may take for the investment to double, which is a consequence of the investment's riskiness. The S&P 500 index funds are the first investment choice we will discuss in this video. An S&P 500 index fund is a wonderful option for more typical banking products or bonds if you wish to attain larger returns, but it does come with increased volatility. The fund is made up of around 500 of the largest American corporations, which means it includes many of the world's most successful businesses. Amazon and Berkshire Hathaway, for example, are two of the index's most notable members. An S&P 500 index fund, like practically any other fund, provides rapid diversification by allowing you to hold a portion of each of those firms. Because the fund invests in companies across all industries, it is more resilient than many other investments. Over time, the index has averaged a 10% yearly return. These products have very low expense ratios and are among the best index funds available. Because it provides wide, diversified stock market exposure, an S&P 500 index is an ideal alternative for new investors. This is a terrific option for any stock investor searching for a well-diversified portfolio and who can commit a 3 to 5 year investing horizon. Dividend stock funds are also a good choice when it comes to investing. Stocks that pay dividends, on the other hand, can make your stock market investments a little safer. Dividends are portions of a company's profits that can be paid out to shareholders regularly, usually quarterly. With a dividend stock, you'll not only get a return on your investment over time, but also get paid in the short term. Individual stock purchases, whether they provide dividends or not, are best suited for intermediate and advanced investors. However, you can limit your risk by purchasing a group of them in a stock fund. Dividend stock funds are a terrific choice for practically any type of stock investor, but they are especially good for those seeking income. These may appeal to those who require income and are willing to invest for prolonged periods. Dividend stocks, like any other stock investment, carry risk. They're considered safer than growth companies or other nonprofit dividend-paying equities, but you should pick wisely for your portfolio. Invest in firms that have a track record of increasing dividends rather than those with the highest current yield. That could indicate impending danger. However, even well-regarded corporations can have financial difficulties. Thus, a high reputation is no guarantee that the company would not decrease or eliminate its dividend. Buying a dividend stock fund with a diverse group of assets, on the other hand, eliminates many of these dangers by minimizing your reliance on any particular business. We also introduced to you exchange-traded funds, or ETFs, as the finest investment option. ETFs are a simple and low-cost approach to diversify your investment portfolio. ETFs, which were first established in 1993, today have a market capitalization of over $4.4 trillion in the United States alone. Here are 5 simple steps to help you get started investing in ETFs. ETFs are considered low-risk investments since they are low-cost and carry a basket of stocks or other securities, allowing for more diversification. ETFs are a suitable sort of asset for most individual investors to use to develop a diversified portfolio. Furthermore, as compared to actively managed funds, ETFs have lower expense ratios, are more tax efficient, and allow dividends to be reinvested promptly. Holding ETFs, however, comes with its own set of risks, as well as tax implications that vary depending on the type of ETF. With no nimble manager to buffer performance from a downward move, vehicles like ETFs that live by an index can die by an index. Good day, mate. We've made it halfway through our list, and we sincerely hope you've enjoyed it thus far. If you have, please give us a thumbs up and turn on notifications to be notified of new uploads. Let's talk about how to invest in ETFs now. Decide what financial goals you want to achieve before you start investing in exchange-traded funds. Which exchange-traded funds make the most sense for your portfolio will be determined by how you intend to use the returns from your ETF investments. Understanding your timeline is crucial to setting your financial objectives when investing in exchange-traded funds. When will you need to start withdrawing funds from your investment portfolio? Consider less hazardous ETF options if you need money sooner, such as for a down payment on a property. You can afford to take on more risk with stock ETFs if you're investing in ETFs for a long-term goal, such as retirement. The next step is to do research into potential ETF investments. There are thousands of ETFs available to choose from. As a result, researching potential ETF investments is critical to ensuring that you select the optimal investment for your objectives. You should now open an investment account to buy ETFs. You'll need to open a brokerage account or other type of investing account to invest in ETFs. These accounts are available from most major brokerages for ETF investing. Each broker's account registration process and requirements are different. Check the firm's investing minimums, ETF selections, and fees before creating an account to be sure they match your needs. Now make a plan to continue investing in ETFs. For most investors, making consistent incremental additions to their investment portfolio is a great strategy. Because exchange-traded funds, unlike mutual funds, have no minimum purchase amounts, they are ideal for this type of investing. Furthermore, an increasing number of online brokers now provide fractional shares of ETFs. This allows you to start investing in ETFs even if you don't have enough money to buy entire shares. Finally, think about your ETF exit strategy. Long-term investing is wise, but even with the most long-term intentions, you'll eventually need to sell your ETF shares and utilize your investment gains. Before you invest in ETFs, consider the following benefits and drawbacks to help you make an informed decision. ETFs have several benefits, especially when compared to their mutual fund siblings. Let's begin with diversification. A single ETF can provide exposure to a group of stocks, market segments, or styles. An ETF can follow a bigger variety of stocks or even try to replicate the results of a country or a group of countries. It trades like a stock. Even though the ETF provides diversity, it lacks the trading liquidity of the stock. Because ETFs are traded like stock, you may instantly look up the ETF's approximate daily price change and compare it to its index sector or commodity using its ticker symbol. Many stock websites have superior chat manipulation interfaces over commodities websites, and some even have apps for your mobile devices. ETFs offer lower fees as well. It has substantially lower expense ratios than actively managed funds, which are what most mutual funds are. What causes the expense ratio of a mutual fund to rise? Management fees, shareholder accounting expenditures at the fund level, service fees such as marketing, paying a board of directors, and load fees for sale and distribution are all examples of costs. While ETFs have numerous advantages, they also have disadvantages. Among them are the following. Diversification is limited in ETFs. Due to a small number of securities in the market index, investors may be limited to large-cap firms in specific sectors or overseas stocks. Due to a lack of exposure to mid- and small-cap companies, ETF investors may miss out on significant growth possibilities. Another disadvantage is that the intraday pricing could be excessive sometime in ETFs. Longer-term investors may not gain from intraday pricing fluctuations because their time horizon is 10 to 15 years. Because of the lagging swings in hourly prices, some investors may trade more. A large change in price over a few hours could trigger a transaction, with pricing at the end of the day preventing irrational worries from distorting an investment goal. In addition to that, the costs could gradually increase. Most people compare trading ETFs to trading other funds, but the costs are higher when comparing ETFs to investing in a specific stock. Although the actual commission paid to the broker may be the same, the stock does not have a management charge. In addition, when more specialty ETFs emerge, they are more likely to track a low-volume index. A wide bid-ask spread could emerge as a result of this. You might be able to get a better deal by investing in genuine equities. What do you think? Are ETFs going to be the best option for you? That concludes today's video. Please subscribe to the channel and enable alerts to be notified of new uploads. This is financial and investment wisdom, and we'll see you in our next video.